Welcome to Corporate Finance Unleashed. Today, we're talking about something every shareholder and investor needs to understand. How do corporate taxes affect your earnings? As a shareholder, it's easy to look at a company's profits and think, great, I'll get a nice dividend. But there's more going on behind the scenes. Let's break it down. When a company earns money, it's taxed before anything is distributed to shareholders. This tax is called corporate tax. The amount the company is taxed depends on the corporate tax rate, which varies by country, but let's assume for simplicity that the company is taxed at 25%. So if a company earns $100 in profits, $25 goes to taxes, and the remaining $75 is left for distribution as dividends or reinvestment. Now, let's assume the company decides to distribute its remaining profits as dividends to you, the shareholder. But here's the catch. Dividends are also taxed as personal income. The rate for dividend taxes depends on your tax bracket. For this example, let's assume the dividend tax rate is 20%. So, of the $75 you receive as a dividend, you now owe $15 in taxes to the government. That's 20% of $75, leaving you with $60 in your pocket. Key concept: the same earnings are taxed twice, once at the corporate level and again at the personal level when dividends are paid. So, what's the total tax burden on the company's original earnings? Let's recap. First, $25 was taken as corporate tax, and then $15 was taken as personal income tax on dividends. Altogether, that's $40 in taxes on the company's original $100 in earnings, a total tax rate of 40%. Only $60 ends up in your hands. Key concept: this concept is known as double taxation. Corporate earnings are taxed twice before the shareholder can fully benefit. So, why does this matter? As a shareholder, understanding the tax implications of dividends helps to make better financial decisions. It's not just about how much a company earns, it's about how much of those earnings actually make it to you. Some companies try to avoid this double taxation by reinvesting profits instead of paying dividends or engaging in stock buybacks, which can be more tax efficient for shareholders. As an investor, understanding these strategies helps you optimize your portfolio. The company pays taxes on its earnings. For example, with a 25% corporate tax rate, $25 is paid out of $100 in earnings, leaving $75 to distribute as dividends. The remaining $75 can either be reinvested or paid out as dividends to shareholders. Let's assume it's all distributed as dividends. As a shareholder, you are taxed again on the dividends you receive. At a 20% dividend tax rate, you owe $15 on the $75 in dividends, leaving you with $60. So, in total, $40 is paid in taxes out of the original $100 in corporate earnings. That's a combined 40% tax rate. The effective tax rate on the original earnings ends up being 40%. This is known as double taxation. The same earnings are taxed twice before they reach the shareholder. Alternatively, companies may choose to repurchase shares rather than paying dividends. This reduces the number of shares outstanding, which increases earnings per share and can lead to higher share prices without triggering dividend taxes. Corporate earnings are taxed twice, once at the corporate level and again as personal income on dividends. Understanding how taxes impact your returns as a shareholder can influence your investment decisions. Companies often use strategies like reinvesting profits or stock buybacks to reduce the tax burden on shareholders. Which would you prefer, dividends or stock buybacks? Comment on your preferred strategy to cope with double taxation. Thanks for watching. If you want to learn more about how corporate finance impacts your financial decisions, make sure to subscribe and check out my upcoming videos. Here's to your continued mastery of the money game.